Hello and welcome. In this video, we'll discuss margins and leverage in trading. We'll cover what margins and leverage really mean, the initial margin and the maintenance margin, the variation margin, margin calls, and how positions are closed out. To make things concrete, we'll walk through a realistic example using a long position in an index futures contract, specifically the E-mini S&P 500 futures, commonly known by its symbol ES. Note that the same principles apply with necessary modifications to long or short positions in other contracts, index futures, stock futures, commodity futures, forex trades, and OTC derivative contracts where margins are allowed. So let's get going. First, let's discuss why margins exist. Suppose you believe the S&P 500 index is going to rise. You decide to take a long position in the ES contract. Let's say the futures contract is currently trading at 7,000 points. Each point in the ES contract is worth $50. This means that the total value of one futures contract is $7,000 to $50, which is $350,000. Now imagine you want to buy 10 contracts. That's a total exposure of $3.5 million. Clearly, most traders don't have that kind of money lying around. In fact, even affording one futures contract outright would be difficult for most people. If traders had to pay the full contract value upfront, futures markets will be inaccessible and illiquid. That's exactly why margin trading exists. To make futures contracts affordable and liquid, exchanges allow traders to control contracts by depositing only a fraction of the total value. This fraction is called the margin. The more affordable the contract, the more the trading volume or liquidity. And liquidity has its positive consequences, like better price discovery, which is great for traders. And more trading volume also means more money for exchanges in terms of fees and charges. And obviously the brokers are happy because they get more commissions because of larger number of trades. Margin requirements are set by clearing houses associated with each exchange. The clearing house sets margin rules, enforces them, and ensures that trades are settled properly. In other words, the clearing house makes sure that the buyers get their contracts, the sellers get paid, and defaults are avoided. You don't need to worry about the plumbing behind the scenes. Just understand that margin rules exist to keep the system liquid, stable, and reliable. Let's first discuss the initial margin, which is paying a fraction for the full exposure. Let's assume that the clearinghouse requires you to pay 10% of the contract value for gaining exposure to ES contracts. That means instead of paying $350,000 for one contract, you only need to deposit 10% of $350,000, which is $35,000. With just $35,000, you can initiate a long position in one ES contract and thereby gain exposure to a $350,000 contract. This amount of $35,000 is called the initial margin, which is basically the money required to initiate the position. You cannot initiate the position unless you put up this much money with your broker. At first glance, this might seem almost too generous. Isn't this risky for the exchange or the clearinghouse? Not really, and here's why. First, the futures trading is typically short-term trading. It's not long-term investing. Positions are monitored continuously, especially for losses. Second, and more importantly, the margin percentage is not random. The clearing houses analyze historical price movements and volatility. If a contract is unlikely to move more than, say, 10% in the very short term under normal conditions, then a 10% margin is sufficient to cover the expected losses resulting from the fluctuations. If a contract is more volatile, the margin might be set at a 15% or higher rate, or 12% or 11%, whatever. In simple terms, initial margin is designed to cover the expected adverse price movements. It's a risk control tool. It's not a gift of money. So to take a long position in one ES contract, you must deposit at least $35,000 into your brokerage account. This minimum required amount or the initial margin is a must to initiate the position. You cannot open the position unless this amount is available. So you must transfer this amount from your savings account to the brokerage account. And of course, you could transfer a larger amount, but that's up to you. The same concept applies to short positions as well. Here the margin percentage may differ slightly for the same contract. For example, it could be 11% instead of 10% or 9%, but the logic remains the same. The broker's role is that while the clearinghouse may require a margin of 10%, say, your broker can require more. It can set a higher limit of threshold of 11% or 12% instead of 10%. What the broker cannot do is to go below the clearinghouse requirement. Why? Because your broker is responsible for settling trades with the clearinghouse. The broker acts as a well-capitalized intermediary and is held accountable for ensuring that enough funds are always available. Now, what is leverage? Leverage is basically the flip side or the other side of margin. It's another way to look at margins. Leverage is simply the reciprocal of margin percentage. That is, if the margin percentage for a contract is 10% for the initial margin, you get 1 upon 10%, which is 10 times leverage. If the margin percentage is 5%, you get 1 by 5%, which is equal to 20 times leverage. With a 10 times leverage, every 1% move in the contract results in a 10% gain or loss on your margin, the amount which you have deposited with your broker. This is where both opportunity and risk come from. Let's walk through this position step by step. If you deposit $35,000 as initial margin, you get into the position. This amount becomes your margin balance with the broker. In return, you now own a ES futures contract if you execute the trade, but you don't own the underlying index, or if it's a stock future, you don't own the underlying share, but you own the future contract itself. The futures contract, you can sell it or you can hold it, and you can sell it anytime during the market hours. We're talking about long positions now. Similar rules apply for the short position. Now let's see how losses are calculated. The main thing to note is that your profit and loss is calculated on the full contract value, not on your margin. So if the contract moves by 1%, you gain or lose 1% of $350,000, which is the full contract value, not 1% of the $35,000 which you have deposited as margin. So a 1% move in the contract is equal to 3,500, that is 1% of 350,000, not 1% of $35,000, which would be 350. So 1% move in the contract will have a $3,500 impact on your margin balance. Now suppose you bought the contract at 7,000 points and now the future price falls by 1% from 7,000 to 6,930. This could happen on the same day or the next day or whenever. That's a drop of 70 points. Your loss is $17 to $50, which is $3,500. This loss is immediately deducted from your margin balance. This daily adjustment process is called marking to market, done by the clearinghouse and the intermediaries like brokers. They're all doing it. So your new margin balance becomes $35,000, which you deposited as the initial margin, minus the $3,500, which you lost because of the 1% drop, which is $31,500. This is your margin balance right now. Now comes another critical concept, the maintenance margin. You have taken the position by depositing the initial margin, but the market will obviously fluctuate. And that fluctuation, if it is an adverse movement, will dent your margin balance. So how far below the initial margin level can you go? How far below the clearinghouse will allow your margin balance to fall before it starts getting alarmed? Now that is the maintenance margin level. Maintenance margin is the minimum level of margin balance that you require if you want to maintain the position. That is, you continue with your position without any problems. So the clearinghouse defines this maintenance margin threshold, which is below the initial margin. Let's say the initial margin is 10% and the maintenance margin is 8%. So the initial margin for our contract is 35,000 at 7,000 points and the maintenance margin is 28,000. This gives you a 2% cushion or $7,000 before alarm bells start ringing. That is, this 2% cushion exists to absorb normal market fluctuations without triggering unnecessary alarms. This is the purpose of the maintenance margin. A 2% move in the contract is a 140 point move. 7,000 into 2% is equal to 140 points. So the critical level to watch is 7,000 minus 140, which is 6,860. So let's continue our example. First, let's say the contract drops by just 1% to 6,930 and your margin balance is now 31,500, which is still above the maintenance margin level of 28,000. So there is no problem and the position can be maintained without any additional deposit of funds. Now the contract, suppose it falls further to 6,790. That's another 140 point drop, another 2% if you consider the base as the 7,000 points initial level. And your additional loss is now 140 into $50, which is 7,000. Now your margin balance slips from 31,500 to 24,500 because of the $7,000 loss. Now this is below the $28,000 figure, the maintenance margin figure. At this point, your broker is required to issue a margin call. Now the broker will demand enough money to bring your margin balance back to the initial margin level. That is $35,000, not $28,000. You don't have to top up the margin just up to the maintenance margin level of 28,000. You have to bring it all the way back up to the initial margin level of $35,000. The required amount is $35,000 minus 24,500, which is 10,500. Now this amount is called the variation margin. This variation margin must be deposited within the time specified by the broker, say one trading day or something. And if you fail to do so, the broker has the right to sell the futures contract and close your position, whether you like it or not. This is done to prevent losses from exceeding your available funds. Then, because the clearinghouse doesn't want any defaults to take place, therefore, it sets this maintenance margin level at which the broker asks you for more money to fund your margin balance so that there is always enough money to settle contracts. If you look at this graphic, you started on, let's say, day 0 at 35,000. The contract fell by 1% from 7,000 to 6,930. Initially, you had a cushion of 7,000. Now that cushion has been slightly eroded. Now 7,000 into 50 points, which is 3,500. That is half your cushion is gone now. and the new margin balance is 31,500. This is still above the maintenance margin of 28,000, so there is no alarm. Now suppose there is a critical drop and the margin balance falls to 24,500 because of a drop from 6930 to 6790. The mark-to-market loss of 140 points is equal to a $7,000 loss, and this causes the broker to issue a margin call, and a top-up is required. And if you don't top up, the broker has the right to sell your position and recover the loss, and that will immediately stop further losses. So to recap, the margins make futures trading accessible and liquid. Of course, they may have many other purposes as well, but this is the main thing. They also magnify both gains and losses. Leverage is powerful but unforgiving. In our example, we have only considered a down move, but we could have had a scenario where the index went up by 3%, 4%, increasing the margin balance. In that situation, there is no need to worry because your margin balance will remain well above the maintenance margin. Moreover, you could always, even before the margin call, you can add money in your broker's account, and if you add money, your margin balance will increase by the amount you have deposited. So you can do a periodic deposit just to avoid a margin call situation in case markets are not going in your favor. So you can do that as well. And whenever you add, the new margin balance will reflect that. Let's revisit the important concepts again. Initial margin is the minimum amount you must deposit to open a position. This is your entry ticket. You can't take a position without depositing this amount. This is set by the clearinghouse. Margin balance is your current account balance with your broker after marking to market. Note that this is an adjustment on paper. You have not actually sold the futures contract to book the loss, but the broker has to keep updating based on the adverse movement in the market. Maintenance margin is the minimum balance you must maintain to keep your position open. It is less than the initial margin percentage, say 80% of the initial margin. Variation margin is the top-up amount needed when you get a margin call, that it brings back your initial margin, to the initial margin level. Leverage is the multiplier effect of trading on margin. For example, 10% margin basically means 1 by 10% leverage, which is 10 times leverage. Margin call is the notification that your balance has dropped below the maintenance margin and you need to deposit more money. Marking to market is a daily process of applying your gains or losses to your margin balance. It's not just about losses, but the main focus is on losses because that is what erodes your margin balance. Remember, leverage amplifies both your gains and losses. A 1% move in the contract becomes a 10% moves in your margin balance when you are using 10 times leverage. So we hope that you have understood the concepts related to margins. Thanks for watching and happy learning.